Hello, everyone. In this segment of the Continuous Disclosure 101 series, I will discuss National Instrument 52110 Audit Committees. As a general reminder, the videos of this series are intended to be an introduction to each topic and are focused only on the requirements under Alberta securities legislation. We remind issuers that the securities exchange that they are listed on may have their own policies and rules regarding governance requirements or disclosure. We encourage issuers to seek legal advice with respect to their specific circumstances. In addition, the views expressed in this presentation are those of the presenters and may not represent those of the ASC, other securities regulators in Canada, or other staff. In this presentation, I'll address who is subject to National Instrument 52110, the definition of an audit committee and its purpose, the responsibilities of the audit committee composition requirements, the meaning of the terms independence and financial literacy for the purpose of this rule, reporting obligations, and common issues that we see regarding audit committees and related disclosure. National Instrument 52110 applies to all reporting issuers other than investment funds, issuers of asset-backed securities, designated foreign issuers, SEC foreign issuers, certain exchangeable security issuers and credit support issuers, and issuers that are subsidiary entities if they don't have equity securities trading on a marketplace and their parent is subject to the requirements of the instrument. It requires issuers to have an audit committee that complies with the instrument and requires issuers to have their external auditors report directly to the audit committee. Although venture issuers are subject to National Instrument 52110, the requirements are modified for venture issuers. Further, it should also be noted that an issuer that has securities listed or quoted on a U.S. marketplace is exempt from certain requirements regarding the instrument if they are in compliance with the requirements of that marketplace. Issuers that fall into this category should review Section 7.1 of the instrument for more information. An audit committee, as defined in the instrument, is a committee or an equivalent body established by and among the board of directors of an issuer for the purpose of overseeing the accounting and financial reporting processes of the issuer and audits of the financial statements of the issuer, and if no such committee exists, the entire board of directors of the issuer. The purpose of audit committee requirements and disclosure is to encourage issuers to establish and maintain strong, effective, and independent audit committees to enhance the quality of their financial disclosure. This will ultimately foster increased investor confidence in Canada's capital markets. So jumping right into the requirements of the instrument, to accomplish their purpose, all audit committees must take on certain responsibilities as outlined in Section 2.3 of the instrument. Audit committees are responsible for making recommendations to the board of directors regarding the external auditor to be nominated for the purpose of preparing an auditor's report or performing other audit, review, or attest services for the issuer and recommending the compensation of the auditor, directly overseeing the work of the external auditor, including the resolution of disagreements between management and the external auditor regarding financial reporting, pre-approving all non-audit services to be provided by the external auditor. Additional provisions regarding pre-approval procedures are outlined in Sections 2.4, 2.5, and 2.6 of the instrument. Reviewing the issuer's financial statements, MD&A, and annual and interim profit or loss press releases before the issuer publicly discloses them. Ensuring that adequate procedures are in place for the review of the issuer's public disclosure of financial information extracted or derived from the issuer's financial statements. Establishing procedures for the receipt, retention, and treatment of complaints received by the issuer regarding accounting, internal accounting controls, or auditing matters, and the confidential, anonymous submission by employees of concerns regarding questionable accounting or auditing matters, and reviewing and approving the issuer's hiring policies regarding partners, employees, and former partners and employees of the present and former external auditor. Finally, audit committees are required to have a written charter that sets out their mandate and responsibilities. In order to carry out their responsibilities, in accordance with Section 4.1 of the instrument, issuers must provide audit committees with the authority to engage independent counsel and other advisors the committee determines necessary, to set and pay compensation for any advisors they employ, and to communicate directly with internal and external auditors, In fact, Section 2.2 of the instrument requires issuers to have their external auditor report directly to the Audit Committee. The composition requirements for audit committees differ between venture and non-venture issuers. Subject to certain limited exceptions, Section 3.1 of the instrument requires that the audit committees of non-venture issuers be composed of a minimum of 3 members, and every member be a director of the issuer, be independent, and be financially literate. So with regards to these composition requirements, what does it mean to be independent? Well, it's stated in Section 1.4 of the instrument that an audit committee member is independent if he or she has no direct or indirect material relationship with the issuer. It's further explained that a material relationship is a relationship which could, in the view of the issuer's board of directors, be reasonably expected to interfere with the exercise of a member's independent judgment. Therefore, the board of directors of an issuer must use their reasonable judgment to determine whether such a material relationship exists in order to conclude as to whether a member would be considered to be independent or not. However, as outlined in subsection 1.43 and section 1.5, certain individuals are considered under the instrument to have a material relationship with an issuer regardless of the board's assessment. For example, an individual who has been, within the last 3 years, an employee or executive officer of an issuer would be considered to have a material relationship with an issuer and would therefore not be considered to be independent. Further, an issuer who accepts directly or indirectly any consulting, advisory, or other compensation from the issuer or any subsidiary entity of the issuer, other than as remuneration for acting in his or her capacity as a member of the board of directors or any board committee, is considered to have a material relationship with the issuer and would therefore not be considered to be independent. Additionally, under Section 1.5, an individual who is an affiliated entity of the issuer or any of its subsidiary entities is also considered to have a material relationship with the issuer and would not be considered to be independent. For the purposes of this instrument, a person or company is considered to be an affiliated entity of another person or company if one of them controls or is controlled by the other, or if both persons or companies are controlled by the same person or company, or if the person is an individual who is both a director and an employee of an affiliated entity, or an executive officer, general partner, or managing member of an affiliated entity. So, for example, if an individual is on the board of directors of, or is an executive of a company that has a controlling interest in the issuer, the individual would not be considered independent. Please see subsection 1.43, the instrument, for the list of additional individuals that are considered to have a material relationship with the issuer. It's worth noting that the specific definition of independence I've been explaining, as used in the instrument, is only relevant to non-venture issuers. I'll discuss the requirements for venture issuers in a moment. Similarly, the requirement for financial literacy also only applies to non-venture issuers. So what does financial literacy involve? Well, under the instrument, an individual is financially literate if he or she has the ability to read and understand a set of financial statements that presents a breadth and level of complexity of accounting issues that are generally comparable to the breadth and complexity of the issues that can reasonably be expected to be raised by the issuer's financial statements. In our view, it's not always necessary for an audit committee member to have a comprehensive knowledge of GAAP and GAAS to be considered financially literate. However, based on this definition, if a non-venture issuer's business and accounting is complex, we would expect that its audit committee members would be required to have a greater degree of education and experience in this regard compared to an issuer with a simpler business. Therefore, an issuer's board of directors will need to evaluate an individual's background, education, and experience and use their knowledge about the issuer to evaluate whether an individual is financially literate in the context of the issuer's business. As I'll discuss later in the presentation, issuers will need to disclose each audit committee member's relevant education and experience to demonstrate their level of proficiency. Now that I've discussed the general compositional requirements of non-venture issuer audit committees, it's worth noting that there are some exemptions available under certain circumstances, as outlined in sections 3.2 to 3.9 of the instrument. For example, if the death, disability, or resignation of an audit committee member has resulted in a vacancy on the audit committee that the board of directors is required to fill, a newly appointed audit committee member appointed to fill such a vacancy is exempt from the requirements in subsections 3.13 and 3.14 regarding independence and financial literacy until the later of the issuer's next annual meeting and the date that is 6 months from the day the vacancy was created. However, it should be noted that certain exemptions are not available unless the majority of the audit committee members would be independent, and the board of directors has determined that reliance on the exemption will not materially adversely affect the ability of the audit committee to act independently and to satisfy the other requirements of the instrument. Additionally, as I indicated with the death, disability, or resignation exemption, many of the exemptions are temporary exemptions that are only available for a limited time period. Moving on to venture issuers. Venture issuers are not subject to the independence and financial literacy requirements that apply to non-venture issuers, and instead are subject to the tailored requirements outlined in Section 6.1.1 of the instrument. Like non-venture issuers, the audit committee of a venture issuer must be composed of a minimum of 3 members, and every member must be a director of the issuer. However, rather than requiring that all directors be independent, the instrument requires that a majority of the members must not be executive officers, employees, or control persons of the venture issuer or of an affiliate of the venture issuer. Venture issuers may very well want to ensure that they have some level of financial literacy on their audit committee, but the instrument does not mandate it. However, as I'll discuss in more detail later in the presentation, venture issuers are required to disclose each audit committee member's relevant education and experience, including whether they are independent and financially literate. Again, there are some exemptions available to venture issuers regarding audit committee composition requirements. Specifically, an issuer is exempt from the requirement to have a majority of its audit committee members not be executive officers, employees, or control persons of the venture issuer, where circumstances arise that affect the business or operations of the venture issuer and a reasonable person would conclude that the circumstances can best be addressed by a member of the audit committee becoming an executive officer or employee of the venture issuer. If an audit committee member becomes a control person of the venture issuer or an affiliate for reasons outside the member's reasonable control, and if a vacancy arises as a result of the death, incapacity, or resignation of an audit committee member, and the board of directors is required to fill the vacancy. These exemptions are temporary and would apply only until the later of the next annual meeting and the date that is 6 months after the date on which the related circumstances arose. Now on to disclosure requirements. Audit committee disclosure is required to be filed annually. Non-venture issuers must provide the disclosure as specified by Form 52-110F1, and it must be provided in their annual information form or AIF. If a non-venture issuer solicits proxies from security holders for the purpose of electing directors, they must include in their management information circular a cross-reference to the sections in their AIF that contain this information. The disclosure required by a venture issuer is set out in a different, more simplified form, Form 52-110F2. A venture issuer that solicits proxies from security holders for the purpose of electing directors must include the required disclosure in their management information circular. If they're not required to send a management information circular, venture issuers must provide this disclosure in their annual MD&A, or, if they have one, their AIF. As outlined in Form 52-110, F1 and F2, both venture and non-venture issuers are required to provide the text of the audit committee's charter, name each audit committee member and state whether or not the member is independent and financially literate. Significantly, although the independence and financial literacy composition requirements don't apply to venture issuers, they are still required to provide this disclosure. Describe the education and experience of each audit committee member that is relevant to the performance of his or her responsibilities as an audit committee member, and in particular, disclose any education or experience that would provide the member with an understanding of the accounting principles used by the issuer to prepare its financial statements, the ability to assess the general application of such accounting principles in connection with estimates, accruals, and provisions, an understanding of internal controls and procedures for financial reporting, an experience preparing, auditing, analyzing, or evaluating financial statements that present a breadth and level of complexity of accounting issues that are generally comparable to the breadth and complexity of issues that can reasonably be expected to be raised by the issuer's financial statements, or experience actively supervising one or more individuals engaged in such activities. The companion policy to the instrument clarifies that active supervision is more than the mere existence of a traditional hierarchical reporting relationship between supervisor and those being supervised, and it should not be presumed that an executive officer is involved in actively supervising these processes. An individual engaged in active supervision participates in and contributes to the process of addressing the same general types of issues involved in preparation, auditing, analysis, or evaluation of financial statements, and would require a general expertise in the area. Additionally, issuers must state whether a recommendation of the Audit Committee to nominate or compensate an external auditor was not adopted by the Board of Directors, and if so, explain why. Describe any policies and procedures that the Audit Committee has adopted regarding the engagement of non-audit services, and disclose external audit service fees by category for each of the last 2 fiscal years. Categories include audit fees, audit-related fees, tax fees, and other fees. Further, in the case of both venture and non-venture issuers, if they've relied on exemptions from the instrument, they will need to disclose that and provide certain information specified in the applicable form. Additionally, venture issuers must specifically disclose that they are relying on the exemption in Section 6.1 of the instrument, which indicates that venture issuers are exempt from Part 3, composition of the Audit Committee, and Part 5, reporting obligations. Finally, I'll discuss some common issues that staff have identified in our continuous disclosure reviews. Staff have on occasion found that the composition of the Audit Committee didn't meet the requirements of the instrument. In some cases, issuers had too few Audit Committee members, members of a non-venture issuer were not independent, or venture issuers did not have a majority of members that were not executive officers, employees, or control persons, and no exemption was available. When we encounter these problems, the issuer may be noted in default on the ASC's website in the list of reporting issuers, pursuant to Section 4 of the Appendix to ASC Policy 51601, Reporting Issuers List, until the matter is corrected. The other main issue that staff often identify is a failure to file the required Audit Committee disclosure. In this circumstance, issuers may also be noted in default under Section 1 of the Appendix to ASC Policy 51601 until the required disclosure is filed. That wraps up our overview of National Instrument 52110 Audit Committees, which is part of the Continuous Disclosure 101 series. You can find more videos at asc.ca. If you have any questions, please reach out to the contacts listed. Thank you for taking the time to watch.